This is a quick video lesson related to the Course 1 on Basics of Accounting. And basically what I'll do is I'll walk you through the source of the inputs for accounting all the way through the accounting process to the outputs, which are financial statements. So if you want to understand accounting, you can really start with your checkbook, your own personal checkbook. For example, every month you consume electricity and you have to pay the utility company. The utility company is the vendor or supplier. They provide you with services. You consume those services and you have to pay for them. So you get your checkbook out and you write out a check and pay the utility company. And when you do that, that triggers an accounting transaction. And transactions in the accounting world are posted against general ledger accounts. And every time you have a transaction in accounting, you're going to have at least 2 entries that you post to accounts. One entry will be called a debit entry, and the other entry we'll call a credit entry. So if we follow up on this utility that we consume, we got our checkbook out, wrote out check 113 on March the 11th. We paid the utility company $79.55. That entry is going to go to 2 general ledger accounts. We debit utility expense. That increases the utility expense, and we paid out cash. We credit the cash account. Most transactions are cash basis transactions, but at the end of the accounting period you're also going to make accrual entries, because for financial reporting purposes you must do accrual basis accounting, not cash basis accounting. For example, you might have depreciation on equipment. You also accrue expenses you incurred. For example, maybe you incurred some costs but you haven't paid them out yet, so you may accrue a payable. And you may have earned some revenue from someone. You'll recognize that and collect the cash later. So in order to record all the different transactions that you might have in a typical business, for example, you'll have various resource accounts like cash, receivables, and inventory, the economic resources for driving revenue in the business. You'll have some liability accounts such as accounts payable, loans payable, and then the money that you put into the business will go to a general ledger account called owner's capital. Those accounts always have a balance in them. We'll call them balance sheet accounts. Then you have some accounts to capture the revenues and expenses of the business, such as sales revenue. If you're in the inventory business, you'll have an account for the cost of inventory called cost of goods sold. You have administrative expenses, you have depreciation expense, and the utility expense we talked about. So those accounts make up the income statement accounts. So once we've posted all these transactions to all these general ledger accounts, what we want to do is we want to kind of group all the accounts into 5 different buckets. We'll collect all the asset accounts, the liability accounts, the equity accounts. Those accounts will be used to structure something called the balance sheet. And then the revenue accounts and the expense accounts will be grouped together, and that'll form what's called the income statement. Now keep in mind also there's this thing called the accounting equation, which means all of the accounts related to assets will be in balance with the sum of all the accounts for liabilities and equity. That's an important accounting concept. The revenues do not necessarily have to be in balance with the expense accounts, because basically the difference between the revenues and expense accounts represents how much money you either lost or made in the business. So now that we have our transactions posted and we've got them all grouped together, and what we want to do is run something called the trial balance out of the accounting system. And what it does is it says here's all the balances in all the different accounts. And basically, as of a cutoff date, which is usually the end of every month, you'll run the trial balance. You'll look at those balances, and those balances are basically reflective of cash basis accounting. So this is the time when you look back and you make some adjusting entries to get your books so that they are accrual basis, like we said, depreciation expense or something like that. And you may even have some correcting entries. Maybe you misclassified something. So this is the time when you get the books all clean and ready to go and accrued, and that gives you the adjusted trial balance. And those are the balances we're going to use to report on the financial statements. So we've got all of the entries posted, adjusted on the trial balance. So now we're ready to generate the output from the accounting cycle. That's the financial statements. And basically you're interested in 3 financial statements that you want to generate. One's called the balance sheet. That's the assets, liabilities, and equity accounts. That's the balances as of a certain date. Then you generate the income statement, which is the profit and loss of the company. And then you have a statement of cash flow that reflects the different sources and activities for cash flow, operating, investment, and financing activities. And once you get those financial statements generated, then you can pretty much close the thing out and you restart the whole process all over again. When I say close it out, you're basically closing out what's called nominal accounts, which are income statement accounts, into an account called retained earnings on the balance sheet. And just to recap and give you the more bigger picture is every month every company goes through this process, and basically 80% of their transactions are cash flow transactions. They have cash coming in, and most of those transactions are sales transactions. They may have some financing transactions where they went and borrowed money from somebody. That's money going into their checkbook, and then they pay money out. Those are cash outflows. They go out and purchase things, or they pay people. That's 80% of the transactions going into the accounting system, and then every month they make accrual entries, and that goes into the general ledger accounts. And like I said, the big output every month for a company from the accounting cycle are the financial statements. So this slide basically gives you the overview of how the process goes every month for every company.